There are some people who retire with just one account, a 401k, for example, that they move to an IRA and start pulling income from. But the majority of people that we talk to here, they have multiple accounts. They have a 401k and a Roth IRA and a brokerage account, which I call a superhero account. And they have an HSA and they've inherited money. And they're wondering, where should we pull from first to optimize our retirement to minimize our tax liability? So that's what today's about. Now, I have other videos you can see where I talk about what is the withdrawal strategy? What's the timing? How do we think about it? And I give stories and analogies that hopefully make it so that you feel a whole lot more confident for your retirement. And I'm also very transparent about it. I'm going to start with my financial answer for you today, and then I'm going to give you a few stories. So if you get your answer and you feel it's what you need, perfect. See you later. But if you want to hang out for the stories, would love to have you. And I do these not just to be silly. I do this because I find it's what really cements the math that I talk about in my videos. Now I'm going to start with the sample case studies that you guys can see how I think about this. So you can see here, there's a sample case. They are 57 and 51 and a 24-year-old child. They want to retire. They want to start enjoying their life. And you can see here, they have $25,000 in their bank account, $600,000 in a home that they have paid off, and $1.5 million in investable assets. $550 is in a 401k, $80 is in a Roth, $25 HSA, $735 in the spouse's 401k, and $145,000 in a superhero account. So they're wondering, what should we do? Well, I'll just tell you what traditionally I would look at. The first thing I would do is I would use a software like this, which you can get in the description below or otherwise, because if you click on this retirement tab, and then you click on cash flows, which I know you're like, okay, well, I don't have this software. I know many of you don't, many of you do, but I'm just showing you an example. If you go under accounts, you can literally click withdrawal from accounts, and it's going to spit out the software answer. I'm not saying it's what you should follow because it depends on your inputs and if you're doing everything properly. But you can see what the software is saying is you should pull from your taxable account in this year, then this year, then this year, then you should do a portion taxable, a portion 401k, continue 401k, take a little bit from your HSA in these few years here, and then it looks like your Roth IRA is basically never touched because you never even got anywhere close to spending the amount of money because you're in a good spot. So you're projected to never have to withdraw from that if your other assets keep growing. Now, if you don't have access to a tool like this, no worries. I'm going to still explain how you should think about this. The first thing is, do you have a superhero account? I have a few videos where I talk about the importance of these, but I'm going to show you a real example in 1 minute so that you can go, wow, yep, I need to get on this. Now, before I show you that, my name is Ari Taublieb. I'm a certified financial planner, host of the podcast Early Retirement, and Chief Growth Officer here at Root Financial. A large majority of people that I speak with have no idea that you can pay 0% in taxes. They'll think, oh, is that something like that Ozark Netflix show? Is that like illegal? No. This is perfectly legal. Just most people don't know about it. So let's look at an example here. This here is the federal income tax brackets that we all are subject to today. So the first $23,000 you make, if you're married filing jointly, you're taxed at 10%. $23,000 and $96,000, 12%, and so on. This is what applies if you pull your money from a 401k. So if you take your money from a 401k and you want to live off $100,000, you take $100,000. The first 23 is taxed at 10%. The next amount's taxed at 12%, and then a small portion will be taxed at 22%. That's not how it works if you are pulling from a brokerage account. With a brokerage account, the first $96,700 is taxed at 0%. Amounts above that are 15%, plus you have the standard deduction that you can add on. And that standard deduction would apply if you took it from your 401k as well. So why am I showing you this example? Well, let's look at a sample case. Let's pretend you wanted to live off $100,000 a year in the first year of retirement, and you wanted to pull from a 401k. From your 401k, it's all taxable as ordinary income. So you'd pay $8,150 in federal taxes, another $3,400 in California taxes. So you'd have an effective rate of 11.5% or $11,500. So if you pulled $100,000 from your 401k, you pay $11,500 in taxes, you have $88,500 left to spend. Now pretend you have a brokerage account and you also want to live off $100,000. The first $67,000 of that, let's say, is your cost basis, which means $33,333. I'm just picking a random number here, but let's just pretend $67,000 is what you bought Apple stock for. It grew by $33,000, so now we're at a nice even $100,000. I could have picked 50. It doesn't matter, but $33,000. Your federal tax bill would be zero. Why? Because you're under $96,000. You're at $33,000. In California taxes, you're at about $300, which means your total tax would be $300 or 0.3%. So a superhero account or a brokerage account, that's going to give you the best chance at minimizing your tax liability. Now, I don't want you to start beating yourself up because many of you will say, why didn't I have this brokerage account earlier? I didn't know about these benefits. Well, the reason is when you put your money into a brokerage account, you don't get a tax deduction that year. So what that just showed you looked really good, but it did not factor in the fact that if you put money into a brokerage account, that's money that you otherwise didn't get a tax deduction on that has now gone to your 401k. Otherwise said, if you were to elect to not do the brokerage account, you're going to save on taxes in a single year. So if you have, let's just say $100,000, that's your income, and you want to put $20,000 into a 401k, you get a tax deduction on that, which means that's $20,000 that you don't have to pay taxes on. That goes to your 401k, and that gets to grow tax deferred. It grows and grows and grows. In the future, you take it out. So that's $20,000 that went to your 401k that, yes, eventually you pay taxes on, but you didn't have to pay taxes on it initially. With a brokerage account, you would have had to go pay taxes on it. So if you make $100,000 and you're, let's just say, in a 20% tax bracket, you're having to go pay 20% in taxes to say, yep, I'll take the money and then go invest it. So you're not actually ending up with that full 20,000, you're ending up with 16,000, 4,000 fewer dollars that goes and gets invested. And with a brokerage account, you do pay taxes along the way. So as it grows, dividends and interest are taxable. Difference being with a 401k, you don't pay taxes on that. The dividends and interest that grows tax deferred. So there's benefits to both, obviously. When you pull from a 401k, you have to pay taxes because you got a deduction early on. With a brokerage account, you don't have to. However, if you had a brokerage account throughout your whole career, the reality is you might be paying crazy taxes. And what you don't want to do is only have one account. This is why it's so valuable to have what the superhero account is called a bridge account. You want to have a portion in there that allows you to do really cool tax planning things. For example, pretend you want to do a Roth conversion. Pretend you want to optimize your healthcare. If you're pulling from a 401k, your income is going to be very high. If you pull from a superhero account, your income can be much lower, so you can qualify for a subsidy. You can do Roth conversions more effectively because you're not going to be in as high of a tax bracket. So there's a general rule of thumb that people will follow, which is pull from a brokerage account first. Then from there, go to a 401k. Why in there? 401k IRA, that's a pre-tax account that you're going to have to eventually have what are called RMDs on, required minimum distributions, where generally, for most of you, age 75, 73 for some of you, you're going to be forced to take out more than you might even need. And so we want to reduce the potential tax liability there. The third account there is that HSA. Now, for some of you, you want it to continue growing because you're always going to use it for healthcare related expenses. There's other people that go at 65, I now know I can just pull from it and use it as I see fit, like an IRA. So I want to do that. And then the Roth IRA. The Roth IRA is the best account for tax-free growth. So that's why we generally want to hold that and not pull from it if we can, because it's going to keep growing tax-free forever. Now, the example I showed you here on my screen, here's someone with a Roth IRA, and it's saying never pull from it. So some of you are like, well, what's the point? Why would I save and invest just to never pull from it? Well, for some of you, you have heirs or a spouse that you want, if something happens to you, you want them to make sure they have the most tax efficient dollars. There's others of you who go, no, I'm here to spend it. Nobody's right, nobody's wrong. But that brokerage account is my pro tip for withdrawal strategies. What I will say is when it comes to withdrawal strategies, I invite you to think about it like a business owner. So here's the analogy that I said at the beginning I would tell you. So many of you know that when you retire, it's a stressful time. It's the first time you have to create income on your own. But I actually think it's a fun time. And the reason I say that is not just because you have time to now do whatever the heck you want to do, but because you really get to be your own employer. Some people that stresses out, but it shouldn't. And here's why. When you are your own boss, I want you to pretend for a second you have a really successful business. If you have a business that's doing really well, you might go hire employees. Maybe you'll go buy equipment. Maybe you'll try to innovate the business in some way. So let's pretend you have $1 million portfolio and markets are up 15%. Your $1 million grew by 15%. That's $150,000 more dollars. In that year, do you think that would be a good year to maybe go invest, maybe buy some equipment? Probably, if you're a business owner. Now, pretend the business is doing poorly. Are you going to go invest that year and buy new equipment? Probably not the year to do that. Same thing when you retire, you're the employer. So the difference here is you're not running some manufacturing company. This is your own retirement. So I say this because most people retire and go, I'm going to spend $6,000 a month every month no matter what, or $5,000 a month, or 10. That's not the reality of retirement. The reality is you should look at it year by year. And if markets are doing really well, you should go, wait a second. I wanted to take that trip. This is the year to take the extra trip. Markets are doing well. Business is doing well. There's other years where, and this is where many of you don't like me, but to me it's just rational. If markets aren't doing well, I'll have clients go, I want to take the same trips as last year. And I go, you can't. It's your prerogative. It's your money. But as your guide, I recommend in this case, possibly considering actually not taking 5 trips, but taking 3 trips and doing that home remodel. Or actually, because we need to focus on healthcare expenses until Medicare kicks in, would you be willing to hold off on 2 trips because this means we're going to be able to do this conversion strategy, which means you might have way more money to spend on travel. And I'll have clients go, yeah, I see what you're saying there, but I want to take the trip anyway. This is when I have my health. And I'll say, great, go do it. But I need you to understand the trade-offs from a quantified perspective. Now, the ultimate goal here is you live your best life. So what I don't want you to do is overanalyze the numbers to the point where you go, oh my gosh, markets went up, but markets are going to go down another year. So let's just like save some extra in case, so there's other years I'm okay. You're only retiring hypothetically when you're in a position where regardless if markets do well or do poorly, you know you're in a good spot. I'm talking about when do we take those extra trips and when do we cut back a little bit so we don't put too much pressure on our portfolio. Those are the little tweaks that we're recommending as business owners. Another way of looking at it is bowling. When you're bowling, you could be really bad like me and you almost hit the people to the lane next to you, or you could use the cheat code. And the cheat code is with the bumpers. So in bowling, you try to hit over as many pins as you can, obviously. The cheat code is having bumpers. And that's our role with our clients, is to go, here's the most you can spend this year. Here's the least you can spend. If you don't at least spend this, we're doing some tax or charitable strategy to save you more money over the long term. And if you want to spend over this amount, it means something else is going to have to give. And let's talk about what that might be. So hopefully this was helpful regarding withdrawal strategy. You can use the software I showed you today if you just want to like calculate it for yourself and have it spit out the numbers. If you want to personally be obviously doing this, you can continue watching these videos. And then if you want to work with Root Financial because you want a true holistic partner with tax and estate and healthcare and all this good stuff we love talking about, I encourage you to go to our website, rootfinancial.com, click see if you're a fit, and then you'll be prompted to answer a few questions and talk very soon. Thanks, guys.